So you want to understand the secret behind Warren Buffett's famous rules about not losing money? Let's dive deep into these rules, exploring not just what they mean on the surface, but how they play out in the real world, particularly when it comes to a company's profitability and the devastating effects of negative compounding. What do Warren Buffett's rules really mean? When Warren Buffett says, rule number 1, don't lose money. Rule number 2, don't forget rule number 1. He isn't just offering a catchy piece of advice. He's providing a fundamental principle that should guide every financial decision you make. But what does he mean by don't lose money? Surely every investor knows that losing money is bad, but Buffett's wisdom goes deeper than that. Buffett's advice is rooted in the basic principle of preservation of capital. Losing money in an investment not only reduces your capital, but also impacts your ability to earn returns in the future. Imagine you have $100,000 invested in a stock. If that stock drops by 50%, you're left with $50,000. To recover from that 50% loss, you would need a 100% gain just to get back to even. This is where the real danger lies: negative compounding. Losses not only diminish your immediate capital, but also significantly hinder your ability to grow your wealth over time. So, why is negative compounding so dangerous? To fully appreciate Buffett's rules, you need to understand the concept of compounding, both in its positive and negative forms. Positive compounding is your best friend in investing. It's the phenomenon where your returns generate more returns, leading to exponential growth over time. However, negative compounding, which occurs when you lose money, works against you in the exact opposite way. When you lose money, you're not just losing a chunk of your capital. You're also losing the potential future returns that capital could have earned. Think of it like this. If you lose 20% of your capital, the remaining 80% must now work harder to make up the lost ground. And the bigger the loss, the harder it is to recover. That's why Buffett's first rule is so critical. It's not just about avoiding losses. It's about understanding how losses compound over time and can derail your financial goals. But how does a company's underlying profitability tie into this? Now let's connect this to the underlying profitability of a company. When you're investing, you're essentially buying a piece of a business. The value of that business, and by extension, your investment, is fundamentally tied to its profitability. A company that consistently generates profits is more likely to grow over time, which in turn can lead to higher stock prices and dividends. On the other hand, a company that struggles to turn a profit is more likely to see its stock price decline, which can lead to the dreaded negative compounding effect. So how do you avoid investing in companies that will lose you money? The key is to focus on businesses with strong, durable competitive advantages, what Buffett calls economic moats. These are companies that can maintain their profitability over the long term because they have something unique that competitors can't easily replicate. This could be a strong brand, proprietary technology, or a cost advantage. For example, take a look at a company like Coca-Cola. It has a powerful brand that has been built over decades, giving it pricing power and a loyal customer base. This kind of business is more likely to maintain its profitability even in tough economic times, protecting your investment from the risk of negative compounding. So why is it so important to focus on profitability? You might be wondering, why is profitability so important? Can't companies grow even if they're not making a profit? While it's true that some companies can grow without being immediately profitable, particularly in the tech sector, this kind of growth is often risky and unsustainable. Without profitability, a company has to rely on external funding to survive, which can be volatile and uncertain. Eventually, investors will demand that the company turn a profit, and if it can't, the stock price is likely to suffer. A profitable company, on the other hand, generates its own cash flow. This gives it the flexibility to invest in new opportunities, pay down debt, and return money to shareholders through dividends and stock buybacks. Profitability is the lifeblood of a business, and without it, the risk of losing money and facing negative compounding increases dramatically. But when should you apply Buffett's rules? Buffett's rules should be applied every time you consider an investment. Whether you're buying stocks, real estate, or any other asset, the principle remains the same. Don't lose money. But this doesn't mean you should never take risks. Investing is inherently risky, and it's impossible to avoid losses entirely. However, by focusing on businesses with strong profitability and competitive advantages, you can minimize the risk of significant losses and protect yourself from the negative effects of compounding. One classic example of Buffett applying these rules is his investment in American Express during the 1960s. At the time, American Express was embroiled in the salad oil scandal, which caused its stock price to plummet. Many investors were scared off, but Buffett saw an opportunity. He understood that despite the short-term crisis, American Express had a strong underlying business with a valuable brand and a profitable core. By investing when others were fearful, he was able to buy the stock at a discount. And over time, American Express recovered and thrived, generating substantial returns. How can you protect yourself from negative compounding? Protecting yourself from negative compounding involves more than just avoiding bad investments. It requires a disciplined approach to investing that emphasizes capital preservation and long-term growth. Here are a few strategies you can use. Diversification. Spread your investments across different asset classes and industries. This reduces the risk that a single bad investment will drag down your entire portfolio. Focus on quality. Invest in high-quality companies with strong profitability, durable competitive advantages, and solid balance sheets. These companies are more likely to withstand economic downturns and continue generating returns over the long term. Avoid speculation. Resist the temptation to chase after hot stocks or speculative investments. These may offer the potential for quick gains, but they also come with a high risk of losing money. Think long-term. Don't get caught up in short-term market fluctuations. Instead, focus on the long-term prospects of your investments and be patient. Over time, quality investments tend to appreciate in value even if they experience short-term volatility. But what are the broader implications of Buffett's rules? Buffett's rules aren't just about investing in stocks. They apply to almost every financial decision you make. Whether you're buying a home, starting a business, or even saving for retirement, the principle of don't lose money is key to achieving financial success. For example, when buying a home, you should be cautious not to overextend yourself financially. Buying more house than you can afford may lead to financial stress. And in the worst case, you could lose your home if you can't keep up with the payments. By sticking to a budget and ensuring you have a financial cushion, you can protect yourself from this kind of loss. In the context of starting a business, Buffett's rules suggest that you should be very careful with your initial capital. Many businesses fail because they run out of money before they can become profitable. By managing your expenses carefully and focusing on building a profitable business model from the start, you can increase your chances of success and avoid the negative effects of compounding losses. So what's the bottom line when it comes to Warren Buffett's advice? It's simple but profound. Protecting your capital should be your top priority as an investor. This means not just avoiding obvious risks, but also understanding the subtle ways in which losses can compound over time and undermine your financial goals. Buffett's rules remind us that investing is as much about avoiding mistakes as it is about making smart decisions. By focusing on companies with strong underlying profitability, diversifying your investments, and thinking long-term, you can protect yourself from the devastating effects of negative compounding and put yourself on the path to financial success. If you're serious about growing your wealth and want more insights like these, be sure to check out our YouTube channel. Withdrawal Investing Insights. Here's to your financial success.